Hi, today we are going to do an analysis of why ICICI Bank has now become the new favorite in private Indian banks. Uh, we are going to compare it mainly with HDFC Bank because HDFC is the market leader in private banks in India for a long time. And we're going to compare important fundamental ratios and see why ICICI is the new darling of the market. Uh, the disclaimer is that I have been invested in both these banks for more than 6 years now, and I have been studying the Indian private and public banking sector for more than 10 years. So, with that information, let's begin our analysis today. Let's begin our analysis with interest, which is the main source of income for any bank. The way banks earn is through interest. They give out loans and they earn interest on it. And you can see that when we compare HDFC with ICICI for the past 5 years, HDFC has shown much more growth than what ICICI has for the past 5 years. It has, if you look at from 2017, it began with 38,000 crores of interest earnings, which was comparable to ICICI's 34,000 crores. But now you can see that in 2021, HDFC has earned around 59,000 crores, while ICICI still is around 42,000. So the staggering difference of 17,000 crores is the outperformance of HDFC in the past 5 years. So from the interest computation itself, we can see that HDFC has a lead in historic computations. Now, interest is not only shouldn't be viewed in standalone. The interest is also to be viewed with net interest margin. So the margin is how much of the interest differential is there in a bank. So when a bank gives out loans, it gains interest, and when a bank gives interest for you on FDs and other schemes, it has to give interest. So the difference between the interest that it earned and the interest that it spent is the net interest margin. And in net interest margin, you can see that HDFC has always had a standard net interest margin of around higher 3.8% kind of. That's the margin, and it's always been constant. So HDFC is one of these banks which manage their risk and portfolio very well, and that is why you can see that the net interest margin always stay constant. Same can be said for ICICI, although the margins have always been historically lower as compared to HDFC, and that is why HDFC is the leader, like I said earlier. So we'll move on. You can see that in both interest and net interest margin, HDFC is a better performer than ICICI. Now, net profit margin. This is called the net profit margin is profit to revenue ratio, and you can see that HDFC also has constantly improved its profit margin from higher 20% to 24%. ICICI has been variable. In 2018 or 2018-19, there was a management change, and after that ICICI has improved its profitability a lot. And you can see that in 4 out of 5 years, the net profit margin was around 15-16%. We can say the average, but last year it was around 22.83%, which is amazing for a bank of ICICI size. They have started to mimic numbers like HDFC. Yes, another important metric, and I think the most important metric, at least for me, is NPA. If you remember the previous financial crisis in Indian banking sector, it was due to a large number of NPAs in the private sector banks. A lot of banks, or NBFCs, had to close down due to big NPA numbers in the past 5 years. So this NPA number is something that is always being tracked by all investors, and as you can see, this is the gross NPA number, which means that this is the entire loan default for a bank. And you can see that HDFC has always had a very stable NPA number around 1.2 or 1.3%, which is amazing for HDFC, right? For ICICI, it has been a very high number, and in order to counter this, they have a large number of provisions. This is just because of the way business is done in these two banks. ICICI does not have a comparable retail loan book as compared to HDFC. HDFC Bank has a larger retail loan book, which naturally means lower NPAs, or at least naturally, historically, it has meant lower NPAs. So if NPA is what makes you safer or sleep better at night, then HDFC is a better investment for you in terms of gross NPA numbers. Again, these are very important metrics for any business, not just banks. And you can see the ROE and ROCE for HDFC have been very stable. Like any other multi-bagger stock, HDFC has an ROE of around 15-16%, and this has been constant for the past 5 years. You can see it's been very, very constant around that 15% mark. ICICI, on the other hand, has been oscillating a lot. It began from 10% and it's now at 11 or 12%. But in the middle years, it was very low when there was a change in management or a change in approach. So for the past 5 years, it has not been stable, the ROE. For ROCE as well, 7% is very stable for HDFC, and they try to maintain it at that percent. Around 7%, which is also very, very good for a financial institution, because they earn through interest, like I mentioned earlier. This is not a standard business where ROE and ROCE will always exceed 15% for numerous years, right? This is a bank, and 7% is excellent. And for ICICI, I think it has always been around 6.5%, the ROCE. So in comparison, you can see that ROE and ROCE for HDFC Bank have always been stable, and that is why HDFC Bank is a much more stabler investment. So why is the ICICI Bank being preferred? We'll get that towards the end of the video. There is one more important ratio that I want to point out, and this is just a health metric for all banks. You can see these are the bank's total deposit that they have in terms of percentage. So HDFC has always maintained around a 46%, and ICICI has also maintained around like 48 to 50% of the CASA ratio, which is amazing. This means that both the banks have healthy deposit ratios, and a lot of people keep their money in these two banks, and there is a lot of trust with these two banks as well. So now we'll come to the main point. You can see that through HDFC and ICICI comparison, HDFC has been a much more stable performer. And if you were to invest in 2022, you were invested in HDFC, right? But if you look at the market for the past year, you can see that everybody is more gung-ho about ICICI Bank as an investment. And the reasons are the revenue increases for 2021. Whatever has happened in the past years has happened, right? You cannot have a hindsight and invest for the future. The market is investing in ICICI Bank's future. They think that ICICI is going to converge its numbers towards HDFC, and it's going to give a very tough competition to HDFC for the number one spot. I think 2021 numbers will give us an indication of why ICICI is now the preferred institution for investments. You can see, let's begin with the revenue increases. So in revenue increase number, you can see that in March quarter for 2021, HDFC had 2.6% of revenue increase. Then Corona happened, or there was another deadly wave in India, and you can see that in the June quarter, the revenue fell with 4.8%. And in the September quarter, it again increased by 6.4%, recovering all the losses that happened during the June quarter. But for ICICI, you can see that the revenue fell by 1.8% during the March quarter. It then improved by 1.7%, and then again improved by 6.7%. So the way ICICI Bank did business in 2021 was better than what HDFC Bank did, at least in strict revenue numbers. In net profits, we can see that in 2021, HDFC's profit fell by 6.5% in the March quarter. Then they again fell with 5.5% in by quarter-on-quarter analysis. They again fell by 5.5% in the June quarter, and then they improved in September quarter in 14.3%. When the market stabilized and when the economy stabilized and when there was no wave, no new COVID wave, right? For ICICI, in March quarter only, it fell 10.8%. And then it stabilized for 2 quarters in 4.8% during June and 19.3% in September. So the net profit for ICICI has increased for the past 2 quarters, while for HDFC it has fallen for 1 quarter and then increased, and the increase is also not as comparable to ICICI, which is why people are thinking that ICICI has done something better in their both investments and the income that they have generated, and that is very visible from 2021 numbers itself. There is one more issue I would like to share. This is the gross NPA. As you have seen earlier, ICICI's gross NPA is around 6.5 to 7% on a yearly basis. Now if you look at ICICI's gross NPA number here, you can see that it's now beginning to go lower than 5%, and it is staying constant around that 5% mark, which is amazing. That means ICICI's asset quality is improving by a quarter on quarter basis, and when this year ends, we will have the gross NPA at around 5%, which is amazing. And if ICICI is able to continue this, then their asset quality will improve, their profit margins will improve, and they will compete with HDFC on those fronts as well. As far as HDFC is concerned, there is no NPA issue as such. It is still hovering around that 1.3% mark, but that is what is expected of HDFC. If it were to lower, then we would see a much more aggressive investment in HDFC Bank as well. And another important thing that has happened in HDFC is the digital outages, due to which RBI added an embargo on HDFC Bank, saying that you cannot roll out new credit cards, which is why the credit card growth for the past 1.5-2 years for HDFC has been around 17%, and this is absolute numbers. So an absolute number of 17% gain on HDFC Bank. In the meanwhile, ICICI has gained 62% in credit card growth. So you can see why ICICI Bank is being favored now as the new favorite, and there is a huge backlog of growth that ICICI Bank did not unlock, and now it is starting to unlock its potential, and you can see much more price action movement for ICICI Bank. Again, while concluding, I hope that you understand HDFC is a much more stabler investment, where you can definitely get 15 to 16% growth year on year. But ICICI is starting to unlock its potential, and probably you will get whatever numbers they manage to unlock in the next 3 to 5 years. This is not investment advice. I am not a wealth advisor, and caution to you to invest based on more analysis and by contacting with your wealth advisor. Thank you so much.